Hey everyone. In the last episode, we learned about debits and credits, and we walked through a comprehensive example of how debits and credits affect different accounts. We also saw how debiting and crediting accounts impacts the accounting equation. We mentioned at the end of the video that there must be a more efficient method for keeping track of accounting transactions, as we saw that even after just 3 transactions, it was beginning to get messy. Well, in this episode, we're going to begin learning about that method. The process of going from transaction to summarized information is very important, and it is known as the accounting cycle. Let's take a very broad look at the accounting cycle before we zoom in on the individual processes. The first part of the accounting cycle is the accounting equation, which we've discussed in the previous 2 videos. From the accounting equation, we can begin looking at the accounts that make up the accounting equation, which is called the chart of accounts. From the chart of accounts, we can drill down into individual accounts and look at what are known as T accounts. The T accounts help us keep track of debits and credits, which are recorded in journal entries. This is the process we'll be discussing in this video. Journal entries are posted to the general ledger. And lastly, the general ledger is summarized in the trial balance. We started with the accounting equation. Let's now look at the next element of the accounting cycle. The chart of accounts is a fancy term for all of the accounts in our accounting system. This is something we've hinted at over the course of the first 2 videos. As we know, we have the accounting equation, which we expanded to be as follows. Assets equal liabilities plus common stock plus revenues minus expenses minus dividends. As we previously saw, each section of the accounting equation is comprised of various accounts. For example, assets is made up of accounts such as cash, accounts receivable, inventory, etc. We can look at each section and the accounts contained therein, and if we group them all together, we have what is known as the chart of accounts. Now, many companies may have similar accounts, like almost all companies will have at least one account for cash. But the larger and more complex a company is or becomes, the larger and more complex its chart of accounts can become. A large company could have hundreds of different accounts for cash, each with a distinct name. A situation in which this may arise is when a company has multiple bank accounts. The accounting department will create a new account in its books for each bank account. For example, we could have 3 accounts for cash. Chase 123, Chase account ending 456, Chase account ending 789. For simplicity and learning purposes though, we're going to start with very basic and generic accounts and account names. In our consulting business example, we listed 5 accounts that made up our chart of accounts, which we'll be using again in this video as an example. The accounts were cash, revenue, wages, supplies, and accounts payable. So now that we've established what the chart of accounts is, let's move on to the next step in the accounting cycle, which is the T account. A T account derives its name from the fact it looks like a T. T accounts are very useful in accounting because they help us track the debits and credits for specific accounts. A T account is drawn as follows. On the left-hand side, we have our debits, which are abbreviated using DR. Debits. On the right-hand side, we have our credits, which are abbreviated using CR. Very simply, every transaction that debits an account will be listed on the left, and every transaction that credits an account will be listed on the right. At the end of the period, we can sum up the debits and credits in each account and determine what the ending balance is. With our base knowledge of T accounts, let's now take a look at the next step in the accounting cycle, and then we'll bring it all together using our example. In the last video, we made a table, which was a rough representation of the debits and credits from the accompanying transactions. Now we are going to refine the process and look at the correct way to record these transactions in an action known as booking journal entries. A journal entry is no more than a systematic and universally accepted way of recording transactions. Let's write out what a journal entry might look like before we begin applying the concept to our example. There are several key elements to a journal entry. We start with a journal entry number. This will allow us to reference the journal entry at a later date. For example, if we are looking at our cash account and see a transaction labeled number 1, and we have the date and we want to know what the other side of the entry was, we can easily refer back to the journal entry using the serialized journal entry number. Next, we have the date, which is very important because it allows us to calculate the transactions in an account during specific time periods. If I wanted to see the revenue I recorded in the last 6 months, I can use the journal entry dates as a filter to only show those transactions that hit the revenue account in that time period. Moving along, we list the account that is being affected. This is straightforward. The only caveat is that when booking journal entries, we typically show the accounts that are being debited first, then the accounts being credited underneath. Oftentimes, we will also indent the account being credited to distinguish the difference between debits and credits. Next, we list the amount of debits for the accounts in the transaction, followed by the credits. You'll notice that debits are on the left and credits are on the right, just like we see in our T accounts, and like we'll see in our general ledger and even in some trial balances. Finally, for each journal entry, we generally include a memo or description. A memo is important because it memorializes what the entry was for. So when you're booking journal entries in January and November rolls around and you need to remember why a certain entry was made, memos are your best friend. The memo doesn't have to be long and complicated either, just a simple few words explaining the transaction. Usually a journal entry memo begins with the word to, as in to record the purchase of materials. So if we want to take an example, let's just fill out an example journal entry real quick. We can start with journal entry number 1. We can record our date as 1/1/21. We can record our 2 accounts, so we'll have account number 1. Underneath, we indent, and we have account number 2. Our debit, any amount. Credit, equal amount. And a memo we can use to record the purchase of materials. Now, how do we relate journal entries to T accounts? It's very intuitive. Each journal entry is comprised of at least 2 accounts with equal debits and credits. When an account is debited or credited in a transaction, we record the amount in the appropriate column under the account's T account, along with the journal entry number for reference. The easiest way to see this is to use an example. So for example, I can go up to cash and record my amount, and I'll also record my entry number. And if I have a credit in that account, I can record the amount and the journal entry next to it as well. The easiest way to see this is to use an example, which we're going to use our example from episode 2 of our consulting business. But we're going to do that in the next video. This seems like a good place to stop because we've covered a lot already, and I don't want these videos to become too long to deter people from watching and learning. So in episode 4, we'll cover the comprehensive example, but until next time, thanks for watching.